My name is Michael Grandy. I'm a certified public accountant and I'm a professor at Providence College, teaching managerial accounting this semester. And we're going to be talking about incremental analysis. And we're using the Kimmel 7th edition textbook. And we're going to walk through a couple of problems. Specifically, we're looking at two types of problems today. We're looking at make or buy decisions. And secondly, we're looking at keep or drop a apparently unsuccessful division or product line. So the first we're going to look at make buy decisions. And let's remember what's going on here. It's where the make or buy decision, a company is currently making a component of its product and has a certain cost structure associated with it, but is thinking about buying it from another company. In other words, outsourcing it to another company. So the question is, which is the most cost effective? Which costs less? Does it cost less to make it, or does it cost less to buy it from somebody else? And we really need to understand our cost structure. Let's fully understand that if we decide to buy it from somebody else, then all of the variable costs go away. So direct materials goes away because that's purely variable. The only reason we incur that cost is if we make it. If we buy it from somebody else, the direct labor, we don't have to pay for that either because that's purely variable. And the variable overhead goes away as well because the only time we incur variable costs is if we make something. Please remember, the total cost for a variable cost is quantity times price. The variable cost per unit times the number of units we make. So if the variable cost per unit is $10 a unit, and the number of units we make is 0, the total variable cost is 0. And that applies to direct materials, direct labor, and variable overhead. But what about fixed costs? What happens to fixed costs? Please remember, the definition of a fixed cost is total cost stays the same as volume changes. So whether or not we produce 1 unit, 100 units, 1,000 units, or 0 units, those fixed costs stay in the business. They do not go away unless mentioned otherwise. So the first exercise I would like to look at is exercise 20-6. So that's chapter 20, exercise 6. And so let's read it. It says, Jobs Inc. has recently started the manufacture of Tri-robo, a 3-wheeled robot that can scan a home for fires and gas leaks and then transmit this information to a smartphone. The cost structure to manufacture 20,000 Tri-robos is as follows. And you see here, direct materials, $50 per robot. Direct labor, $40 per robot. Variable overhead, $6 per robot. And then they have allocated fixed overhead, which they've calculated to be $30 per unit. But remember, it's a fixed cost. They have determined, they believe that the cost of manufacturing one of these things is $126 per unit. Jobs is approached by 10th, which offers to make Tri-robo for $115 per unit. So obviously $115 a unit versus $126, they would initially think there would be a cost savings there of $11 per unit. But remember, there are fixed costs involved. And the question is, do the fixed costs go away? So A, using incremental analysis, determine whether Jobs should accept this offer under each of the following independent assumptions. Number 1, assume that none, it says assume that, assume that $405,000 of the fixed overhead cost can be avoided. So what it's saying here, of the $600,000 of fixed cost, 405 of it would go away. 405 would go away. So let's calculate that first scenario. So we have a make or buy. We have under the make side, we have direct materials, $50. Remember, we're making 20,000 of these things. So the direct materials cost is $50, and that would be $1 million of direct materials. The direct labor is at $40 for 20,000 units. That's $800,000. The variable manufacturing overhead is $6, and that would be $120,000. And they're saying, what is avoidable here? In other words, the costs that are there only because they make it. So 405 would be avoided. So that makes the 405 fixed manufacturing overhead, it makes that relevant because that's avoidable. So the total cost is $2,325,000. The relevant costs associated with making it include this number right there, the 405, because that's relevant. The other cost, the other what? $195,000. The $195,000 cost is there. The cost to buy is $2,300,000. 20,000 times 115. So right now, the cost to make is greater than the cost to make is greater than the cost to buy. So your recommendation here is to buy because you don't get rid of enough fixed cost. You have a savings of $75,000. I'm sorry, a savings of $25,000. $25,000 savings. Now, it goes on to say, so that's item one. And it goes on to say, item two, assume that none of the fixed overhead can be avoided. However, if the robots are purchased from 10 jobs, can use the released productive resources to generate additional income of $375,000. So what they're saying here is that none of this goes away. None. So that means there's $600,000 on both sides, right? You could put $600,000 over here and $600,000 over here. The net effect is zero. So I simply say if it's going to be on both sides, it's just as easily removed from both sides. But you still, if you make it, the relevant costs are direct materials, direct labor, and variable overhead. But there's another issue here. There's an opportunity cost. So let's remember what happens here. If this company decides to make it, if this company continues to make it, they have a lost opportunity. Lost opportunity, and a lost opportunity becomes an opportunity cost. So we're going to add that 375 to this side of the equation, and it still only costs $2,300,000 to buy it. That's not going to change, but the cost to make it has changed dramatically. It's now 2,295. So your decision is now going to change because you're going to make it. You're going to make, because even though you have this opportunity cost, it's still cheaper to make it. So recommendation is to make. There's a savings of $5,000. Remember, if they decide to make it, they have a lost opportunity. You add that to this side of the equation. And remember, none of the fixed costs go away. So the next item here, item B, asks, describe the qualitative factors that might affect the decision to purchase the robots from an outside supplier. So here you're looking for non-financial reasons. And there are three substantial non-financial reasons. First one is jobs. Because let's think about it. If they decide to buy it from somebody else, they may have to lay people off. So they would lose jobs. The second item here that you need to worry about is quality. If the company buys it from somebody else, the question is the quality as good as if they made it themselves? So quality is the last one. And the third issue here is delivery. Will the delivery be on time? Obviously, if they make it themselves, it's right there. But if they buy it from somebody else, where's it coming from, and will it arrive on time? So that's exercise 20-6. Let's look at another make or buy question. And this is going to be exercise 20-8. And this is, again, a make or buy question. So it says, Innova uses 1,000 units of its component IMC2 every month to manufacture one of its products. The unit costs incurred to manufacture the component are as follows. Direct materials, direct labor, and overhead. They just give you overhead. So what you need to remember is that overhead tends to be a mixed cost. Well, what does that mean? Well, that means that there is a fixed and a variable component to that cost. So far, they don't say anything. Overhead costs include variable material handling costs of $6.50, which are applied to products on the basis of direct material cost. The remainder of the overhead costs are applied on the basis of direct labor dollars and consist 60% variable, 40% fixed. So again, we're interested in knowing what the breakdown between variable and fixed is. So let's take a look at it. We've got variable and we've got fixed. So they said the total overhead was $126.50, but they specifically said one of the variable pieces is $6.50. That relates specifically to material handling. So you had what? You had $126.50, you minus $6.50, you've got $120 left over. And they say that the remainder, $120, the remainder is applied on the basis of direct labor dollars, and because 60% variable. So 120 times 0.60 is variable, which is what? Is $72. And 40% is $48, so that's 120 times 0.40, right? So total variable and fixed this is going to be $78.50, and this is going to be $48. The two of them added together is $126.50. So now you know what portion is variable and what portion is fixed. It goes on to say, a vendor has offered to supply IMC2 component at the price of $200 per unit. That's the cost of buying. So the first question is, should Innova purchase the component from the outside vendor if Innova's capacity remains idle? So the question is, they got the capacity to do it. So again, we're looking at the cost to make versus the cost to buy. So the cost to make is going to be what? Direct materials, $65, and it's 1,000 units, right? So this is going to be $65,000. Direct labor, $45, and again, it's 1,000 units, so it's $45,000. And the variable manufacturing overhead, remember, the only reason they incur variable overhead is if they make it themselves. 7,850 times 1,000 is $78,500. And we can ignore the fixed cost because what they're telling us here is none of it goes away. So that means whether they make it or they buy it, they're still going to have that $48 per unit. So you can either put it on both sides, the make or the buy, or you can eliminate it from both sides. Because what are we looking for? This is incremental analysis. What's the difference? It's the same in both sides, so there's no difference. So we ignore the fixed overhead. So the cost to make is $188,500. The cost to buy, $200,000. Why? They said $200 per unit, 1,000 units. So it's $200,000. So the recommendation here is to make, because there is a savings of $11,500. They have a savings of $11,500. That's item A. So the second, again, the savings is $11,500. The second question is, should Innova purchase the component from an outside vendor if it can use its facilities to manufacture another product? So again, if they buy it from somebody else, it frees up some space. And it says, again, should Innova purchase the component from an outside vendor if it can use its facility to purchase another product? What information will Innova need to make an accurate decision? Show the calculation. So yes, if they decide to buy it from somebody else, they have the capacity to make something else. This is an opportunity. So what does the opportunity cost have to be to make it work? Well, it needs to generate at least $11,500 of opportunity. It needs to generate at least $11,500 of additional income so that the two become equal. So $11,500 or more will justify them buying it from somebody else. And then lastly, it says, what are the qualitative factors that Innova will have to consider when making this decision? And again, I mentioned quality. If they buy it from somebody else, will the quality be as good? Number two, what about on-time delivery? If they buy it from somebody else, will the component arrive in time for them to put the product together? And lastly, if they buy it from somebody else, do they have to lay off some employees? So those would be the non-financial issues. So the next topic I'd like to look at here in this chapter is keep or drop. So again, the question is, should the company keep or drop what appears to be a non-profitable product line or division of the business? So the first exercise that I'd like to look at is exercise 20-15. And it goes on to say here that Veronica Mars, a recent graduate of Bell's accounting program, evaluated the operating performance of Dunn Company's 6 divisions. Veronica made the following presentation to Dunn's board of directors and suggested the Percy division be eliminated. If the Percy division is eliminated, she said, our profits would increase by $26,000. So what you see here is you've got a contribution format income statement. I'm sorry, it's not a contribution format income statement, is it? It's a traditional income statement. Sales minus cost of goods sold equals gross profit. So it's a traditional income statement. And what you see here is 3 columns. The other 5 divisions combined have a profit of $157,740. But Percy division, their traditional income statement, multi-step income statement, shows a loss of $26,000. So she's making the argument that if we get rid of that one division, we have $26,000 of additional profit. In the Percy division, cost of goods sold is $61,000 variable, $15,000 fixed, for a total of $76,000. And operating expenses are $30,000 variable and $20,000 fixed. Again, total of $50,000. None of the Percy division's fixed costs would be eliminated if the division is discontinued. So what it says here is that those fixed costs, which are $15,000 cost of goods sold and $20,000 operating expense, which is $35,000, $35,000 would not be eliminated, because it's fixed and doesn't go away. So what would it mean? It would be reallocated to the remaining divisions. So they don't get away from that cost. So let's take a look at it. What is it asking? It says, is Veronica right about eliminating the Percy division? Prepare a schedule to support your answer. So what I say is let's first take a look at a contribution format income statement for Percy. So let's remember, we've got we need to figure out what is variable cost versus fixed cost. This is Percy only. We have cost of goods sold. They said the variable was 61, the fixed was 15 for a total of 76, which they show on the traditional income statement. And then the operating expenses, again for Percy, were 30 variable, 20 fixed for a total of 50, which again is what shows up on the traditional income statement. And total variable here is 91, total fixed is 35, and again, this would be a total of 126. This is variable, this is fixed. So let's look at that traditional income statement. For Percy, sales, $100,000. Variable cost, right? 91. Contribution margin, 9. Fixed costs, 35. There's my loss of 26. So none of the fixed costs go away. So what's important to remember, the way I like to look at this, is that if the contribution margin given, you need to look at the contribution margin versus the avoidable expenses. And if the contribution margin given up is greater than the avoidable expenses, you want to keep. So what's happening here? The contribution margin given up is $9,000. The avoidable expenses, 0. None of that goes away. It gets reallocated. So your conclusion, the contribution margin given up is greater than the avoidable expenses. You want to keep that division. So let's also remember this. If the contribution margin given up is less than the avoidable expenses, you're going to drop. If you can get rid of more of those fixed costs than the contribution margin, you would drop it. But in this example, they only get rid of, they're getting rid of $9,000 of contribution margin and 0 avoidable expenses. Your conclusion is to keep. Let's look at one last one. And this is going to be exercise 20-16. And let's read it. It says here, Cauley company makes 3 models of tasers. Information on these products is given below. So you got Tingler, Shocker, and Stunner. Tingler has net income of $30,000, Shocker $70,000, and Stunner has a loss of $40,000. Also note that now you're looking at a contribution format income statement. It goes on to say, fixed expenses consist of $300,000 of common costs allocated to the three products based on relative sales, and additional fixed expenses of $30,000 for Tingler, $80,000 for Shocker, $35,000 for Stunner. The common costs, that's the $300,000, will be incurred regardless of how many models are produced. What that means is that the common costs allocated to Stunner would simply be reallocated to the remaining divisions. The other fixed expenses would be eliminated if a model is phased out. So the second part of those fixed costs are traceable, directly related to each of the divisions. Those would go away. So in this example, some of the fixed costs go away. James Watt, an executive with the company, feels the Stunner line should be discontinued to increase the company's net income. So the first item says, item A, compute current net income for Cauley. So that's just a matter of looking at it on a total basis. So we're going to combine all three divisions. So if we look at the revenue, the sales, you've got 300 for Tingler, 500 for Shocker, 200 for Stunner. That is $1 million. I'm going to drop some zeros and make it easy. The variable cost, 150 for Tingler, 200 for Shocker, 145 for Stunner. That's 495, and that's variable cost. Contribution margin, therefore, is what? 505. And then the fixed costs for all three divisions, 120, 230, and 95, which is a total of 445. So on a combined basis, they have $60,000 of net income. But you can clearly see that the Stunner has the loss of 40. The other two divisions have combined income, net income of 100, right? 30 plus 70 is 100. Minus the $40,000 loss from Stunner, there's your net income on a combined basis of 60. So again, should Cauley eliminate Stunner from the product line? So I need to eventually come to this conclusion. I want to be able to look at contribution margin versus avoidable expenses. So if I get rid of if I get rid of Stunner, that's the question, right? Stunner. The contribution margin given up from Stunner is $55,000. What are the avoidable expenses? The avoidable expenses, the only expenses that go away if I eliminate Stunner are what? Are the $35,000 that's mentioned, right? It says here, it says here that 300,000 is combined. So of this number here, right, you've got allocated or common, they call it common cost, right? Common. They said the common costs are 300 for all of them. And then they said specifically that Tingler was 30, Shocker was 80, and Stunner was 35. If I were to add all those numbers up together, that's the 445, right? So what they're saying here is that these do not go away. The $300,000 does not go away. What does go away, these are avoidable. So if they were to eliminate Stunner, they would eliminate the $35,000. So the $35,000 is an avoidable expense. So in our scenario, the contribution margin given up is greater than the avoidable expenses. Therefore, you want to keep you want to keep that division because it's contributing to cover some of that allocated common cost. So those are the problems for keep or drop. Thank you very much.